We'll give folks one more minute to come in from the hallway, and then we'll get started. I hope you're enjoying today's conference, and I want to introduce myself. My name is Mary Caracoli. I am a board member with the Global Interdependence Center, and I'm really happy to see you all today. The last panel discussion, as we really got into the Q&A session, you saw how interesting the discussion got when we got to sovereign debt. And what I heard in that is methodology matters. And our next speaker, Norbert Guillard, knows that methodology matters. In fact, that is what his dissertation was about. And his new book is A Century of Sovereign Ratings. And he's going to be taking a look at the reliability of the sovereign ratings. And I also want to mention to you that his book is fantastic, and many of you have purchased the book. He will be doing a book signing following his talk here. Actually, it'll be following the entire program. It's going to be the room right adjacent to this program. And if you haven't received the book yet, it is not too late to do that. You can see any of our GIC staff who can make that available to you today. But it is a fascinating read. And it really, his ability to break things down in a way that is easily understood, a very complicated subject, and why methodology is so important is really, it's just really well done, Norbert. That is why you can see him on the media circuit throughout Europe and in the United States, often talking about this very subject. So without further ado, Norbert Guillard.
Thank you, Mary. I think that if we have to talk about the reliability of sovereign ratings, we need to look at two main indicators. First, stability of sovereign ratings, and we know that Moody's during the past decade was very concerned about that. I refer to the papers wrote by Cantor and by Hamilton about the consistency and the stability of sovereign ratings. And on the other hand, of course, there is the quality and the accuracy of sovereign ratings. And it is why I developed in my book, since it is the first ever comparison of performances of credit rating agencies regarding sovereign ratings. So, in introduction, I would like to look at the past, and I think it's very important to understand what happened in the interwar years. We know that sovereign ratings appeared in 1918, and the 1920s were a very specific decade because it was a big shift from the London market to the New York Stock Exchange market. So what we witnessed regarding sovereign ratings during the interwar years is that first, the big credit rating agencies at that time were unable to anticipate the crisis. As you see, we have many upgrades during the second part of the 1920s, and we have very few downgrades, particularly for 1929 and 1930. So we have always the same problem with ratings. There is a lack of anticipation. And of course, by the beginning of the sovereign debt crisis in 1931, I just remind you that the first sovereign default occurred in January 31, it was Bolivia. And from 1931 through 1934, there were many defaults. We consider that around 45–30% of countries defaulted during the 1930s. And we see that during the first half of the 1930s, there were many downgrades. It is very, very impressive. If you look in particular at the year 1932, in red, you realize that it was a very, very tough period for sovereign issuers. If we now consider default rates, that's very interesting to note that contrary to what happened to the corporate area and to the municipal area, there was no big failure in terms of sovereign ratings. I mean that there was no AAA, no country rated AAA in the 1920s, defaulted in the 1930s, except one bond. It was a German bond rated AAA by Fitch in 1929. But actually, it is the exception. And when we look at default rates, we have to admit that AA and AAA rating categories were very safe, which was not the case, for instance, for municipal bond ratings, because, as we know, around 80% of American munis that defaulted in the 1930s were rated in the AA or AAA category in 1929. So, okay, there is a problem of anticipation in the interwar years, but there is no failure as a whole. And I think that's important because today we have more or less the same problematic. We have quite reliable sovereign ratings, but we have always the same problem for Fitch, Moody's, and S&P regarding the anticipation of debt crisis. So now let's look at the modern times, the past decade. We see that we have the same problem with the procyclicality of sovereign ratings for the period 2002-2007. We clearly see that upgrades outnumbered downgrades, that's clear. And from 2008, we have, of course, the contrary with a massive wave of downgrades, particularly in 2009 and 2011, which is not included here, but it will be an important point. Second, I think that beyond the stability and lack of stability of sovereign rating, I think we have to look at, of course, default rates and accuracy ratios. It is what I made in my book, and for the first time I compared the performances of Fitch, Moody's, and S&P for the past decade. To do so, it was actually very simple. I took a common period on the one hand, and on the other hand, I considered a common sample. So I took all sovereigns rated by the three credit rating agencies simultaneously. And I had quite interesting results. First, if we look at cumulative default rates for Fitch, Moody's, and S&P, we have default rates equal to 0 for the AAA, AA, single A category until the BBB minus. Here we have Fitch. For Moody's, we have exactly, we have actually a very, very similar default rates, with the first line with default rates higher than 0 for the BBB minus or Baa3 category. So what we have first, it's not so instructive because we realize that performances of credit ratings are quite similar when examining cumulative default rates. So we have to go further, and to do so we need to compute cumulative accuracy profiles and accuracy ratios. I just remind you that accuracy ratios are a measurement of a rating agency to assign high ratings to issuer that will not default and low ratings to issuer that will default. So it is a way to measure the discrimination on the one hand and to consider the fact that a credit rating agency could issue very low ratings to most issuers, and the agency could conclude, okay, you see, we have no default in the investment grade category, so we are very good. So we require much more from a rating agency. We require that a strong discrimination and a real ability to discriminate and to issue high ratings to issuers that will not default and low ratings to issuers that will default. Because if you have too many sovereigns, for instance, in the double B or in the B category, particularly the B category, that do not subsequently default, it is a problem. It is a problem. So with the computation of cumulative accuracy profiles and the computation of accuracy ratios, we can answer much more cleverly the question. And what I did, it is with a common sample. I compared Fitch, Moody's, and S&P performances. And we see that for the 1 year, 3 year, and 5 year horizons, Fitch has the lowest performance, and Moody's and S&P, as you can see, are very, very similar performances for the past decade. If we take another period with another sample, and if we compare Moody's to S&P for the period 1987-2011, we have more or less the same conclusion, but we have to note that Moody's is slightly more accurate than S&P in the medium term at the 3 and 5 year horizons, and in contrast, S&P is better in the short term, as you can see. So the conclusion we can draw at this stage is that Moody's and S&P today are the two leaders in terms of market shares, of course, as we know, but in terms of performance in the sovereign rating area, really Moody's and S&P outperform Fitch. The problem related to Fitch ratings is that Fitch is too slow when adjusting its ratings. There are several examples. For instance, with Argentina, Moody's was the first agency to downgrade Argentina as early as 1999, and Fitch and S&P lagged behind Moody's on this specific default case. If we take another example, Greece, once again, Fitch and Moody's particularly lagged behind S&P. I think it's important to underline that S&P downgraded Greece as early as 2004 and downgraded the country in January 2009. So S&P was the first to downgrade Greece, to adjust its ratings to the Greece financial stress. And I think that's the main reason why when I will update my work, I will find that S&P is likely to be the most performing agency because it was the first to downgrade Greece, and because S&P ratings were the lowest in January, February, March 2010, when we realized that there was actually a big problem with Greece. So it is, I think, one of the most relevant conclusions of my book. But despite all, I think that we have to mitigate such results for two reasons. First, there have been very few sovereign defaults during the past 2 decades. So when we see that accuracy ratios are very high, when we see that default rates for AAA, AA, single A categories equal 0, we must keep in mind that there were few sovereign defaults, and there were few sovereign defaults because the sample of sovereigns is very small, and in no way it is comparable with the population of corporate issuers. So when we say that sovereign ratings are more accurate than corporate ratings, we cannot say it's completely true because we don't have the same population. And the number of observations is completely different. It is the first point. The second point, it is the fact that sovereign ratings are said to be procyclical. That's partly true, but I think that they turn out to be much less procyclical than market-based indicators. In the last chapter of my book, I make a comparison between sovereign ratings on the one hand and CDS on the other hand. And we see that more or less at the beginning of January 2009, there were actually few gaps between Fitch, Moody's and S&P ratings and CDS, except for Ireland, mainly Ireland, and a little bit Greece, but it was not significant at that time. 1 year later, in January 2010, we realized that there were much more gaps between ratings, sovereign ratings, and CDS. As you can see, for Italy, for Spain, for Ireland, for Greece, there were until 4-5 notched gaps between sovereign ratings and CDS. Here, I did not mention it, but here we have the transformation of CDS into ratings. It's quite easy to make, and it is largely used today by Moody's, for instance. And in May 2010, exactly a week after the first support package for Greece was voted, we note that we have very important gaps for Italy, and particularly Spain, Ireland, Portugal, and Greece. Exactly the countries that experienced big downgrades, multi-notch downgrades in 2010-2011. So, what we can say about that is that sovereign ratings are not so pro-cyclical as we could think. CDS, particularly, and to a lesser extent, market spreads, are much more volatile. So I think it's very important, because I think we need to reduce reliance on credit rating agencies. But I think it would be very dangerous to replace references to credit ratings by market indicators. I think that beyond this comparison, I think despite all, there has been a problem with sovereign rating methodologies, because Iceland were rated AAA in 2007-2008. These countries did not default, but we know that without specific support packages, they would have defaulted in 2009-2010. So we must admit that sovereign rating methodologies should be enhanced. If we look at the main determinants of sovereign ratings, and particularly if we look at the seminal work made by Cantor and Packer, we realize that 5 determinants explain around 85% of sovereign ratings. We know these 5 determinants: GDP per capita, inflation, a debt indicator, which is, the more commonly used is the debt to revenue ratio. Then there is a development indicator, which could be replaced by an indicator of the political and institutional stability, and the indicator for default history. With these 5 determinants, you have more or less, roughly, the black box of sovereign rating methodologies. And what I showed in the book, in the middle of the book, is that these determinants were more or less the same as early as in the 1920s. So what I discovered is that the main criteria used by credit rating analysts have remained more or less the same since the 1920s. It was quite impressive and quite surprising, but I think it is another very interesting finding of the book. Okay, we know that there are other determinants that are taken into account by credit rating agencies to rate sovereigns. For instance, foreign exchange reserves. It was a very important determinant when upgrading the rating of the BRICS, particularly between 2003 and 2008. And there is a second criterion, which is workers' remittances. A very important determinant when agencies have to rate small Central American countries. And most of these countries were downgraded in 2008, so very early, because there was a drop in workers' remittances. Despite all, I think that as we have a problem with sovereign rating methodologies, we can enhance them. I think that, and it will be my conclusion, we need to draw lessons from the sovereign debt crisis. I mean, the European sovereign debt crisis. I think that there is a paradox. Since 2008, since September 2008, Moody's, S&P, and Fitch, to a lesser extent, have made efforts to increase the transparency of their rating methodologies. Moody's began with methodology set by Pierre Caïto as early as September 2008. S&P and Fitch followed, and I think that perhaps the most exhaustive sovereign rating methodology was published by S&P in June 2011. Despite that, I think that, and it is a paradox, we have just witnessed the worst misrating in the sovereign rating area since the 1980s, because Greece has just lapsed into default. So I think there is a paradox. We know that credit rating agencies are more and more transparent on the one hand, and on the other hand, there was a real problem in anticipating the sovereign debt crisis. Why? I think there are several points that are noteworthy. First, and I think it is now commonly admitted by credit rating analysts, it is the fact that there was an excessive belief in the euro umbrella. And today, most analysts, most economists consider that the debt of Greece was, of course, exposed, was very risky, and the entrance in the Eurozone was completely, misunderstanding for both credit rating agencies and investors. Second point, and I will insist on that, I think that the era when GDP per capita and more globally income levels were overestimated is over. I think it does not fit the world we are living today. I think the best example, if we can say, is Greece. We know that Greece has quite high GDP per capita, but the country has by far many other problems that were not taken into account by rating agencies. The first one was debt sustainability. We know all the literature by Reinhardt and Rogoff about that, and I think that we believe that an industrialized country could afford a bigger and bigger debt without any risk of default. I think it was a big mistake, and I think S&P was the first agency to be aware of that. Particularly, I think the approach by David Beers who is the big boss of the sovereign risk unit at S&P. There are other two problems. First, in tax system, I think it was completely neglected by rating agencies. We know what happened and what is still happening in Greece, but we have quite similar problem in most southern European countries. So the tax system is, I think, a very good indicator of the ability of a country to repay its debt. And lastly, I think competitiveness is a big issue too. And when you read the recent downgrades by S&P in January, you realize that S&P refers to the competitiveness of Germany, for instance, and it underpinned the confirmation of the German AAA. And in contrast, there is no reference to competitiveness in the report on France. So we can capture the state of mind of credit rating analysts when we read S&P reports. So in conclusion, I would say that credit rating agencies must understand, and S&P has begun to understand, that welfare states in European countries, and particularly in southern European countries, are not sustainable. They are no more sustainable. We neglected this point during the past decade, and that's the reason why we see these multi-notch downgrades today. Thank you for your attention.
Norbert will be taking questions after the program during the book signing, and he welcomes them. Again, it will follow this program. It'll be in the room adjacent. And a quick GIC promotion, if you would allow me. This fall, we will have our annual celebration. And it is our goal this year to include many of you in our preparation of that celebration. One of our honorees happens to be in the room at the moment. Bill Dunkelberg, our chair, will be receiving the Global Citizen Award and will be honored along with Sharon Javi. And I want to encourage all of our members, as well as our board members and friends of GIC, to become part of this, not just attending, but part of our organization. And if you are interested in participating, please come see me or Jill. You know, many of you know from GIC for many years. Give your information. I'll be in touch with you, and we would like to include you in our preparations this year, or just fill you in on what we're doing, if that's all you'd like. Moving things right along now, I want to introduce Peter Kirstens. Now, Peter has made an excellent career studying how policy and laws are made. And right now, Peter's Counselor, Economic and Financial Affairs for the EU delegation to the United States. And right now, he's going to fill us in on essentially how global investors view the U.S. rating agency. So I can't wait to hear his perspective on that. Come on up, Peter.
Sorry for the cracking. Can you hear me? Well, you still have a few minutes then to change places if you don't want to hear me. On the program, it says that I was going to give a European view or a global investor's view on American rating agencies. And I thought that was a bit of a strange title because, well, it's true that some of the larger rating agencies are in the US, but I don't really think there's such a thing as an American rating agency. There are rating agencies all over the world, but I don't think you can really distinguish Americans from non-American rating agencies. I'd like to say a few words generally about the role of ratings, although much of that has been covered already this morning. And then I want to illustrate what people in Europe, policymakers in Europe, public opinion in Europe thinks about that by going through the measures that have been taken in Europe to regulate the rating space. To illustrate the general opinion, I'll just quote or paraphrase my boss, Commissioner Michel Barnier, when he said that ratings have a direct impact on the markets and the wider economy, and thus on the prosperity of European citizens. They are not just simple opinions. He also said that we can't let ratings increase market volatility further, and that we need to reduce the over-reliance on ratings, while at the same time improving the quality of the rating process. And he said that ratings should become more transparent, that rating agencies should be held accountable, and that we want to increase competition in this sector. These are many objectives to be had. How do you get there? First, a few words on the role of ratings. If you look generally at financial markets, you have to come to the conclusion that rating agencies play an enormous and probably an outsized role in financial markets. They are essential for the confidence of issuers and borrowers, or the confidence in issuers and borrowers, because people look at the ratings and the ratings have an impact on what the market and what people believe about them. But they also play a very, very important role in the regulatory process, because both in the United States, although that legislation is being changed now, or has been changed now, and in Europe, but also in other jurisdictions, capital requirements for financial institutions, for example, depend on ratings. And so if entities are rated down, that has a direct impact on the capital financial institutions need to hold. Despite this enormous and what I would call outsized role, until 2007, especially in the European Union, there was not really any meaningful regulatory attention for rating agencies. There was in the United States, there was at IOSCO level, but in the European Union there wasn't really anything worth talking about. So what have we done to address this? Because as you know, in politics, when politicians are confronted with a problem, they need action. Something needs to be done. And then they look at something, they say, well, this is something, therefore we need to do this. The first thing we did was we came up with a regulation. Because, of course, if you ask a politician or if you confront policymakers with a problem, the answer always is regulation. It's a bit like if you ask, if you're a carpenter, all solutions involve a hammer. If you're a doctor, all solutions involve pills, and so on. Now, we went through various iterations of regulation on credit rating agencies to illustrate the political drive that was behind the issue and the fact that something really needed to be done. The first was in 2009, the proposal was done earlier, but it always takes a bit of time to adopt it, was a regulation on rating agencies at the European level, which covers four grounds. It basically covers the integrity of the rating process, the transparency of the rating process, the responsibility of rating agencies and their governance. I'm not going to go through all of these elements, but I'd like to highlight two of them. One is the registration requirement, so that actually in order to operate the business of a rating agency in the European Union, you have to be registered as a rating agency, and that is to ensure the independence and the integrity of the rating process. But also it comes with a number of conduct of business rules which are compulsory. And these conduct of business rules really focus on the avoidance of the conflicts of interest. We've heard that already this morning, that there are inherent conflicts of interest in the issuer pays model, which appear to be substantiated indeed by the facts that you saw in the structured products markets, that agencies were both consulting on how to structure the products and were rating them at the same time, which wasn't necessarily conducive to an independent rating of those instruments. So Other rules which we have there in the conflict of interest are, for example, the fact that rating analysts are no longer allowed or should not be allowed to have any ownership interests in the entities they rate, because then of course you also have a clear conflict of interest. The rules also govern the quality of rating, and it was already mentioned this morning that not only are rating agencies, of course, allowed, or they should rate entities or instruments, but they should also monitor their rating. They should sort of continuously monitor them and on an ongoing basis to make sure that these ratings are accurate and are still accurate, and that the downgrades are done in good time and not when market pressure just sort of pushes it so far. And on the rating methodologies have to be more rigorous and more documented. And finally, the conduct of business rules require rating agencies to show more transparency and to document the transparency by submitting yearly transparency reports. That got us a long way in the process, but it didn't really seem to establish a necessary degree of confidence, and the political pressure in the European Union, but also at the global level in the context of the G20 and the Financial Stability Board, which is the gathering of global leaders in the regulatory space, felt that more action was necessary to regulate rating agencies. And therefore, and this debate at the G20 level covered 5 issues. The first was that there is a global consensus that there is still an over-reliance on ratings. So the recommendation is that that should be addressed. The second is that the ratings of sovereigns should be reviewed. There's clearly a problem with methodologies and the comparability of ratings of sovereigns compared to ratings of corporates or structured products. A third problem which has been identified is the problem of concentration and competition. There are many rating agencies, but only a few which are very big. If, the figures which I saw were that the 3 biggest occupy about 95% of the global market for ratings, which probably indicates that there is too much concentration there. The fourth issue addressed at the global level is the liability or the responsibility of rating agencies. Should rating agencies be responsible for their ratings? Yes, they are responsible, but should they be liable for their ratings? And the fifth is that despite the fact that various jurisdictions have addressed conflicts of interest, that more needs to be done to address this. The European Commission has acted on these 5 recommendations by tabling a new proposal for regulation in the middle of November last year. And this covers these 5 grounds. And the first element of that proposal is to address the over-reliance of ratings. We basically state that users of ratings should no longer blindly rely on ratings. We saw a practice that many companies didn't really do their due diligence. They just sort of said, well, we looked at the rating, this instrument was AAA rated or whatever it was rated, and that was good enough. So we have done our homework by buying the rating or by just sort of looking up the rating. And reducing the over-reliance of ratings is really to get rid, if you wish, of the quasi-institutional role that ratings play in the financial sector. And we have various instruments to do that. So our regulation governing capital requirements, for example, reduces the number of references to ratings, so the regulatory reference to ratings. There's a specific obligation on financial institutions to do their own due diligence, as I said. And more generally, also not only for banks, but also for money market funds, for other investment vehicles, that there's a general obligation on the managers of these entities to do their own assessments. The European Union did not go as far as the United States went, because the Dodd-Frank Act effectively eliminates the reference to ratings, which is causing a number of problems of its own. We've seen in the last year and a half that US regulators have been struggling to come up with alternatives to ratings, with what we could sort of say mixed results. I don't think the regulators in the US, be it the Federal Reserve, of the Control of the Currency, or the FDIC, can in any way be blamed for having failed to come up with an alternative. It probably is true that they weren't dealt the best hand by Congress, and they are facing a very complex situation that they have to put forward an alternative to ratings with there not being an alternative available. So I wish them a lot of luck. The second area is, so we said reducing the reliance on ratings. The second is to get more transparency and disclosure in ratings and rating methodologies. So that the users of the ratings, the markets have a better idea as to what these ratings really amount to. Sort of what is the underlying or the underpinning methodology and logic of a rating, so that you can actually interpret it. Rating agencies will also be required to communicate their ratings to the European Securities Markets Authority, which will make them widely available. Now, this is of course limited to the issuer-paid ratings. Investor-paid ratings do not fall under this obligation. And rating agencies will also have to consult with issuers and investors on any intended changes of the ratings, so that they know that there is an exchange and people know the grounds for either an upgrade. Although I think often investors are less interested in knowing why they're being upgraded, but they're particularly interested in knowing why they're being downgraded. And that is also that's going to be a requirement, assuming that the proposals which the European Commission made will be adopted. The third area is focuses on sovereign ratings, and there, of course, there have been many problems. We saw that the crisis, in a way, the pro-cyclical effect of ratings was that the crisis was further precipitated by rating agencies. I'm not saying that they caused the crisis, but certainly there was at best a misfortunate coincidence between the performance of certain of the EU member states and the ratings being issued about them and the timing of the publications of those ratings. As a result, the requirement will be that sovereigns in the European Union will have to be rated more often. So not only on a yearly basis, but on a 6-monthly basis. More often is also, of course, possible, but that would be good. And again, investors and member states will have to be better informed about the underlying methodology and assumptions underpinning each rating. Also, to avoid market disruptions, the publication of the ratings will have to be done after the markets in Europe close, or at least 1 hour before the markets open, so that you don't have this immediate shock effect as soon as the information gets put out on the market. I know there's a lot of talk in the United States that the European Union would suspend or prohibit the issuance of ratings, of sovereign ratings. It's true that there is a body of opinion on that subject, and the body of opinion is not negligible, but the European Commission did not retain that option in its proposal. It was debated, but it was not retained. I see that the European Parliament, which is the legislator in Europe, together with the Council of Ministers, in its report on the proposal, and they ultimately will decide, have come back with the idea of the possibility of banning or suspending ratings. Whether that idea will be retained, it's too early to say. I don't have sufficient predictive abilities to assess that. If I had such predictive qualities, I would probably be working for a rating agency. But it's definitely an issue which is there out in the debate. The fourth area, and this has to do with the concentration in rating agencies and the effects concentration has on independence, is that, well, we are looking for more diversity in the rating space and more independence. Now, of course, that sounds a bit like being in favor of blue sky and sunshine. Everyone wants more competition, everyone wants more independence, but it's not always that easy to obtain. Measures that will be put in place to achieve that objective will be that issuers will have to rotate the agencies they use regularly. For example, in principle, they should rotate every 3 years. So you cannot hold on to the same rating agency, because evidence suggests that if rating agencies and analysts, and they'll also have to rotate analysts, if rating agencies and analysts stick too long with a particular entity, that leads to a symbiotic relationship which affects the independence, and we believe it is better that every now and then other people look at the instrument. Second is that for complex structured finance, financial instruments, there will be a requirement to have at least 2 ratings. So there various ideas have been attempted on this. In the United States, for example, although it's not in the Dodd-Frank Act, but in the debate leading up to the Dodd-Frank Act, there was a suggestion, for example, that for structured finance products, rating agencies would get onto a short list of the SEC. So everyone who felt that they were qualified, or everyone who was qualified to rate these instruments, would end up on a list with would apply to be on this list with the SEC. And if you were an issuer of such instruments, you would go to the SEC, and the SEC would actually tell you which of the agency was going to rate the instrument, to avoid conflicts of interest. It's an idea which was out there, but it was not retained in the final legislation, although the SEC is due to make a study on it. So in Europe, we've opted for the solution to have at least 2 ratings, so that the investors can compare this. There's also, to address concentration and to address conflicts of interest in that area, limitations and walls between shareholders and shareholdings, and who you can rate and you cannot rate. So a big shareholder of a credit rating agency cannot also be simultaneously a big shareholder of another rating agency. And also shareholders or companies that are big shareholders that have more than 5% in a rating agency will no longer be allowed to offer consulting services for the entity being rated. These are a number of ideas which are out there, or a number of proposals which are out there to address conflicts of interests. And then finally is that rating agencies should be held more accountable for the ratings they provide. This is a very controversial proposal, because people say that, well, the European Union is going to hold rating agencies responsible and liable for mistakes, or for getting their rating wrong. And it's not like, that's not a correct presentation of the issue. The liability will be there for breach of the rules. So if the rating agencies do not respect methodology, if they do not respect the rules, they can be held liable for that. But they cannot be held liable for being wrong, because we accept and acknowledge that at the end of the day, a rating is still an opinion, an assessment on what the likelihood of default of an instrument or an issuer is. And if you do your assessment correctly, the chances is that the chance will increase that you're right, but there's no guarantee, so you cannot be held liable for that. So these are the 5 areas which are currently subject of regulatory and legislative debate in the European Union, which we hope and expect that once adopted will lead to more stability in this area. What I can say to conclude is that regulating generally for a problem like this is very complex. Regulating in a European Union with 27 countries is more complex. Regulating in a way for 27 countries, in a way that makes sense in a transatlantic context, is, well, my English isn't good enough to find a term to illustrate what it is, but it's more complex. So regulation isn't perfect, but it is generated by what public policy makers perceive as problems that emerge. Really, as a final point before I take questions, is a number of people have mentioned it this morning, that in Europe there was an idea to create a European public rating agency. As with the idea of banning sovereign ratings, it is indeed true that there is a body of opinion, not a marginal body of opinion, but actually quite a significant body of opinion in the European Union that believes that there should be a European public rating agency. The European Commission debated this option as well, but did not retain it in its proposal for two main reasons. One was cost. To set up a credible rating agency would be very costly, and secondly was the credibility of that rating agency would be in question, because while the credibility of rating agencies has been questioned, I think that doubts must also persist as to the credibility of a rating agency that is publicly funded, especially if that rating agency is then going to rate sovereigns. That said, so for these reasons the European Commission did not propose that option, but I do see that the European Parliament in its report has come back with the idea, and given that they are the legislator, the idea may very well find further favor now in the European Union. That said, we are very much aware that, especially in the United States, but not only in the United States, that there are very serious doubts about the fact that governments were to be involved in rating of these of financial instruments. With this, I'd like to open up to questions, so feel free.